Hi, welcome back to another edition of Flippers Fund Flows Insight. My name is Tom Rosine. Thanks for joining me today. I'm going to be reporting flows for the week ended November 13th, 2013. I'm going to be presenting initially numbers that actually represent the conventional fund business X ETFs. We'll talk about ETFs as we get going. I don't think anybody would be surprised when I say that we had minor outflows, $1.4 billion for the week. And they might be a little surprised considering that we hit new records for the S&P and the Dow. But really what happened is we had mixed messages. We had really good news on the non-farm payroll side, GDP, and also on personal income and consumption. But maybe it was just too good. And so investors kind of sat back and said, wow, get a little bit nervous. We heard some Fed presidents come out and basically say, hey, we might have to actually start taking off a little of that easy money as early as December. And another one said, hey, we're going to have to start cutting soon. But everybody sat back and said, let's wait to see what Janet Yellen has to say. And certainly on Thursday was good news as we expected. So let's go ahead and take a look at how this $1.4 billion got pulled out of the industry. Equity funds actually saw $1.7 billion net new money after their coffers. Taxable bond funds took in about $1 billion. Muni bond funds, another one, two to the nose. They lost about $900 million in net new money, money coming out of their coffers. And then money market funds was where the people actually took money and put it back to work. $3.2 billion exiting the coffers of that group. Well, let's see how that translated and moved over into the equity side. Again, I said equities funds actually saw about $1.7 billion net new money. It's the fifth consecutive week that they've seen inflows, and they had about a 0.17% return. So despite hitting new records for the S&P and the Dow, basically that was all just incremental increases and very small returns. And again, investors basically chose to sit back on the sidelines. But what that translated to is, again, $1.7 billion net new money coming into the coffers. Year to date, $173.1 billion. Very good money, very good inflows coming in equity markets. We haven't seen that for quite some time. If we take a look, though, the domestic side actually took in about $500 million of the fifth consecutive week they've seen inflows. And on the non-domestic side, we saw about $1.2 billion of net new money enter their coffers. And it's a 24th consecutive week that we see money come into their coffers. So how that broke out, though, is on the domestic side, we actually saw, I've been talking about large caps and other areas of interest. Actually, people went into gold and natural resources this week and moved about $161 million into theirs. However, on the international side or non-domestic side, international funds took in about $1 billion. And how that broke out is we saw more money going into the European region funds, only 124, but that was where the concentrated money was actually located. Well, let's see how these kind of changes in attitude affected the equity ETF side of the arena. For the second consecutive week, we actually seen outflows out of ETFs, and it was only about $2.7 million. I mean million, not billion. $2.7 million is almost a net wash. And how that occurred is basically the authorized participants got very conservative. They put money to work in SPY, about $1.6 billion. Some more money went into iShares, corporate S&P 500 or core S&P 500 fund. But really where we saw it was kind of the riskier assets taking it on the chin. iShares Russell 2000 saw about $1.6 billion in outflow. And the iShares MSCI emerging market, despite having good news from China, saw about $900 million in outflows as well. So again, this was a conservative focus where we hear good news and then we hear bad news coming after that. So I think people wanted to make sure that in fact it wasn't such good news that we'd actually see the Fed actually doing some things as far as getting rid of some of this easy money. Well, let's see how that impacted the investors on the fixed income side. For the fourth consecutive week, we've actually seen inflows. About $1 billion for this week came into the conventional fund business, and it's the second week in a row that we've actually seen negative performance, about 0.23%. Where the money was going was corporate investment grade debt funds. They took in about $1.6 billion, but how that broke out is loan participation funds, which is grouped into this corporate investment grade debt group, basically saw 817, or the lion's share, enter their coffers, and it's the 74th consecutive week that investors actually put money back to work in loan par funds or adjustable rate mortgage or adjustable rate funds. This makes sense. If you're concerned that the Fed is going to raise interest rates, and we did see some bumps up in the 10-year Treasury this week, not big, but again, there were some bump ups. Basically, that's what you're going to do is you're going to try to hide in that area. On the flip side, where are you going to pull money out of? Well, basically, we saw coming out of government mortgage funds, they saw about $329 million of money exit their coffers, and then we also saw the Treasury and mortgage group also lose about $231 million. So overall, again, this is that conservative approach that investors are actually taking a look at. Well, how did the ETF, the authorized participant investor, behave? Well, we saw about $900 million in outflow, so again, it was about a wash in this case as well. And how that broke out, and again, this was the second consecutive week, by the way, that we've seen authorized participants actually go into a net redemption mode. they were conservative as well. iShare core total United States bond market, basically they only saw about $100 million in net new money coming to their coffers, almost nothing. And then if we take a look at the iShares 1 to 3 year Treasury bond, which by the way, I told you there was an increase, there was actually a decrease in interest rate at the lower end of the curve, only taking about $60 million. But on the flip side, we look at the more aggressive pieces, and when you see the bond market's doing well, the stock market's doing well, you'd expect high yield to actually move as well. We saw the iShares, iBox, high yield corporate actually lose about $280 million. So certainly, again, the authorized participant became a little bit more conservative in thinking that there may be interest rate increases. Well, how did these concept of interest rate increases play on muni bond funds? Same way they played in the last several weeks that we've seen. About $900 million of money came out of the coffers. It's the 25th consecutive week we've seen outflows. It's the second consecutive week, though, that we've actually had negative performance with that, 0.27% loss for the week. And the prior there, obviously, national munis lost about 629. All the rest were single state munis. And certainly it's a story we've been talking about for quite some time. So again, the 25th consecutive week for outflows, and it doesn't look like there's any recovery chance ahead. Although many pundit out there is saying and talking about the idea that they've been throwing the baby out with the bathwater, and certainly there's some yield opportunities to be found in munis. We certainly haven't seen that in the flows yet. Well, that brings us to the money market portion of this section, and it's the first week in four that we've actually seen outflows, about $3.2 billion in outflows. Taxable money market funds saw about $1.6 billion in outflow, and how that broke out. Institutional investors took about $14 million. $1 million, not billion, so almost nothing. They are sitting on the sidelines doing nothing, not putting money to work in fixed income, not putting money into equity, and not taking money out. Again, $14 million, where we saw retail investors, and it makes sense, take out about $1.7 billion, about the same amount that went into equity funds. But on the tax-exempt side, money market funds saw about a $1.6 billion outflow. So certainly, again, we don't see any really solid trends in the money market funds, but it's certainly something that we like to keep a look at and see if there's any big moves either way. Now we get to kind of the end of this piece, and that's where we're going to be able to start looking forward to what's ahead. Certainly, we all heard that Janet Yellen again came out and said, she agrees with what the Fed has been doing, and that we have a lot of work ahead of us to do. And I think for a lot of people that read as we are going to continue on with the easy money policy at least through December. But again, all bets are off. Nobody could pin her down on when she thought tapering should start, and certainly she was doing a good job of trying to be for instance like Volcker, Greenspan, or anybody else who was trying to use a double speak and not tell us anything. We'll have to see what her policies are, obviously, after she takes office, if she does, by the way, in January as well. Well, if you want to do a deeper dive, check out some of the areas that you'd like to do research on. You can go to our website, lipperusfundflows.com, and do a deeper dive. If not, you can join us next week where one of our analysts will talk to you about the trends that occurred in the weekly flows. Well, my name's Tom Rosine. I'm wishing you the best in your wealth planning and creation, and thank you for attending.